Hey everyone, welcome back. Just a quick sound check before we get started on today's webinar. Audio seems to be good on my side, so I guess we can get started. Let me know if there's any issues with audio, otherwise we are going to get started. Tonight we are going to discuss multiple time frame analysis. So I think a lot of people are actually going to be waiting for this one. Probably more for confirmation rather than anything else. Okay, my name is Vito Henjoto, and let's get this started by starting with a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times you should consider the appropriateness of the advice before you act further. We do not offer signal service, managed funds, or other personalized advisory services. Please be aware of scams that promises guaranteed returns or managed accounts. CFDs and Forex are leverage products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Okay. All good? All good? Alright, so let's get started. We will talk about different different trend observation, time frame for intraday traders, what's the time frame for swing traders, what's the time frame for position traders. We'll take a look at the pros and cons, and then the best time frame combination for type of traders. But we are actually going to be doing a lot more practical sessions tonight. So if you have any questions regarding anything, if you're looking at multiple time frames, if it's giving you headaches, hopefully we can resolve that issues for you. Okay, so let's talk about different trend observation. This was previously discussed when we talk about trends in the market. Depending on the time frame that you look at, you're actually going to be looking at different trends. You're going to be observing different trends in the market. So this is where it gets a little bit complicated. All right. So, different time frame basically has a different trend with a different context in mind. And also, if you are using daily and then the hourly time frame, for example, it might show you the same thing. It might show you an uptrend, but it will have a very different meaning in terms of what that uptrend is. One could just be within a correctional phase, the other one could be within a significant uptrend. So, even though it shows you the same thing, it might have two different meanings, and it really depends on the context of use here. So be mindful of that. So the next part is that every trader will pretty much have a different view of those trends because they might be looking at different time frames. So this is where it actually gets really hard when we are talking about trading communities, right? Let's say you are part of a Telegram channel or maybe a Reddit channel, and then people are talking about a certain trend in a certain currency, for example. You might not agree with them, or they might be discussing a different trend that doesn't really apply to your trading. So this is going to be tough, right? Because for beginner traders, this is going to be what we call a burden of information. It will actually be not helpful to your trading. It's actually going to be an obstacle to your trading because it's going to be an obstacle in assessing the direction that the market is moving. And the other thing that I say, because every analyst, every traders, they're looking at different things. Information you obtain from news or other traders, or maybe a trading signal service or a trading signal Telegram channel or whatever, they might lead to a different view from yourself. So that's going to be tough, right? And the reason why I don't want to discuss multiple time frame analysis until we get to the halfway point here right now is that I want you guys to understand how to look at trends that's useful for yourself, right? The time frame that you're familiar with, that's the kind of trend you want to focus on, right? And the reason why I don't want to discuss this until now is that by giving you the understanding on looking at trends that would apply to your trading, that would give you a comparison, right? So You don't just listen to trader A or trader B saying that, oh yeah, a Euro USD is within an uptrend or a downtrend. You guys get to decide what your view is on the market, and that's the thing. The reason is because if trader A says this, you can verify it with your own findings. You can do your analysis yourself, and you understand what you're looking at, and you can disagree or agree with trader A, for example. All right. That's because every news or data, or use, because every news, there's a typo here, right? Because every news and data, they don't really tell you where the view is on that time frame or the trend that they obtain with. So let me give you an illustration. Let's jump straight into the charts here. This is on the pound USD on the daily time frame. Now, if we go by what we know from the Ichimoku Kinko Hyo, the previous sessions and stuff like that, we know the overall trend for the pound USD was within a downtrend ever since the 24th of February 2022, right? That's our view. That's the view given from the daily time frame. Now, if I were to switch onto the hourly time frame, this is going to give you a different view. Because on the hourly time frame, we are looking at a rather persistent uptrend that's been going on ever since the 21st of October, right? So it's been going on for about a week. Again, what are the contexts here? Because we know on the daily time frame, on the longer term time frame, we are looking at the pound USD that's really bearish. It's within a downtrend. Then we have the hourly view of this, and it says, look, it's actually within an uptrend, and it's been within an uptrend since the 21st of October. Now, despite the uptrend that we saw on the hourly time frame, nothing much has changed on the daily time frame. We did talk a little bit about this on Wednesday, that we are actually borderlining on a potential transition on that trend, right? But it doesn't change the fact of the matter is that we haven't seen a new high that's beyond 1.1750. We cannot technically call this an uptrend yet. So this is two different views on the same thing, just different perspective. One on the daily time frame, the other one on the hourly time frame. The session will actually be within the hour, so unless there's a lot of questions asked, then we can extend it. All right, so there's a question here asking about, let me just translate this. If you guys could type in English, because the session is actually going to be in English, that will be great, but I'll translate this one once. So there's a question that's asking about a bigger wave that's being formed on a smaller wave, but that smaller wave can be mapped on the bigger wave. So yes, yes and no. Let me give you the perspective on this. That smaller wave and the bigger wave that we saw or being asked just now. So this is actually a really good question. So let me rephrase that question. Let me translate it on the fly if I can. Is it true that the bigger wave is being formed by the smaller wave, but the smaller wave can actually be mapped on a bigger wave, right? I will translate this as the larger time frame, so the larger trend is going to be affected by the smaller trends, but those smaller trends are actually still contained within the major trend or the underlying trend in the market. So technically, yes. So this is a really good question, and I like this kind of questions. And this is basically the topic of tonight. What we're talking about when we talk about context in multiple time frame analysis is this. You kind of need to understand what is the underlying trend. What is the long-term view of it? So if we take a look at this one here, let me just clear this box here because we don't need that. I'll keep a few of the lines. You know what? I'll actually get rid of it. So here's the thing. I'll get rid of it. All right. Let me prep it. Okay. So on the larger time frame, we know this is technically still a downtrend, yeah? How do we know it's technically still a downtrend? Because we are looking at a market that continues to create a lower low, but we haven't actually technically created a higher high, higher than this level over here. All right, once we break that level, then we actually have a little bit of a confirmation that we could actually be transitioning to an uptrend. Anyway, because it's still contained within this outlook that we have on the daily time frame, whatever that's going on the small time frame, let's say on the hourly time frame, on the 15-minute time frame, still has resistances or limits that still contain on the larger time frame. Now, if I were to do a fib that we have actually take a look at, this is still contained by the 100% retracement level. So we could potentially see a little bit of resistance at around 1.1738, 1.1750. We could see that resistance form. Now, in terms of, are the smaller trends going to have changes on the bigger trend? Yes. So it's always, with multiple time frame analysis, and this is why that's called the burden of information, is that it's really asking that chicken or the egg question every day. All right, which one comes first? Is it the chicken or is it the egg? And that's basically what it is with trends on the daily time frame and on the hourly time frame. Right. So the question is, are the trends on the hourly time frame going to be contained by that trend on the bigger time frame, or the daily trend is going to be affected by the hourly trend? So which one is it? That's going to be the tough one. My point of view is this: assess things pretty much independently every day. It could be useful, but in between the hourly time frame or the daily time frame, I would prefer to stick with the daily time frame as a much stronger indication of what that trend is. Okay, reason is, with multiple time frame analysis, if we go to a small time frame, that's going to be a lot of market noise, and with time frames as you go higher, that market noise get filtered out. Okay, so if we take a look at the daily time frame, there's only one trend pretty much for 2022, and that's the downtrend that started on the 24th of February 2022. Right, so if you guys are looking at the daily time frame as a trend guidance, you don't have a lot of headaches. You're technically looking for a continuous sell in the market. But if I were to switch on to the hourly time frame, within that few swings that we have, we do have a lot of that transition that's going on. We basically on that drop initially, we have price transitioning below the Ishimoku cloud, which is the start of a potential downtrend. That's on the 13th of September. And then we don't actually transition up until about 28th of September. And then it came back down and up again. So it was basically transitioning in and out of a downtrend or an uptrend. And it's completely fine, right? It's not wrong. If you take a look and if you discuss this with someone that look at the trend on the daily time frame, like me, for example, then I'll say, the overall trend is still to the downside. But if you're trading on the intraday scale, the hourly time frame seems okay, because the hourly could represent a weekly trend, all right? And that's perfectly fine. It's perfectly okay. So it's hard to argue which trend is correct. And people say, it's a minor trend, it's a major trend. What I'll say is this: whatever time frame you're trading on, that's the trend that you're looking at. Simple as that. All right. So don't confuse yourself with, this cycle, that cycle, this wave, that wave. All right. Major, minor trend, and whatever. Unless you're really proficient or you're experienced in the market, those words are not going to be helpful to you. All right, the word is not meaningful. The word here is that it's not going to be helpful to you. By taking a look at all these different trends and trying to make sense of it, it's actually going to be an obstacle to your trading. It's not going to help you. It's actually going to hamper your progress when it comes to trading. So, I'm actually going to show you a few tips and tricks on how to use multiple time frames. But, I'm trying to say is this: if you are a beginner and you're having a lot of difficulty in terms of figuring out what that trend is in the market, stick to one time frame. Don't look at multiple time frames. And I would say, you know what? Don't jump onto multiple time frame analysis until you get a hang of looking at trend easily on a single time frame. Okay, so back to the question: does the major wave get affected by whatever's changing on the minor waves? Yes, it does. Is it whatever changes on a small time frame? It's going to affect the longer time frame, but that changes is still going to be limited by what that major time frame is showing you. Okay, so it's a chicken or egg question. There's no real clear answer to that, but does it affect it? Does it have an impact? The answer is yes. Does the small time frame get affected by the larger time frame? Yes. Does the larger time frame get affected by the small time frame? The answer is yes as well. All right, see this? Like, I'm just looking at the questions here, right? We will, we've got a lot of stuff. Some people call it like, I don't know, structures. Some people call it a super trend, whatever. Look, nothing. I'll be honest with you in terms of technical words. Those are just fancy labels. Doesn't really mean anything. Doesn't really help in your trading. How do you identify a super trend, right? I would never use the word super trend, because if I were to say something is within a super trend, the word super means that it's technically irreversible. So yeah, things like that. A lot of traders out there, a lot of educators out there, or a lot of so-called experienced traders out there, they throw in fancy stuff, right? They throw in fancy words at you, thinking that, you know what, throwing fancy stuff like that's going to make me looks really good and stuff like that. I'll be honest with you here, and I'm just going to clarify a lot of stuff. Don't buy into that marketing stuff. A trend is a trend. It's either an uptrend, it's either a downtrend, or it's either in a sideways market condition. Right. In terms of are there structures in the market? Yeah, we do call them impulsive waves or corrective waves in the market. Are there certain patterns to it? Yes, there are certain patterns to it, but I don't really like calling it market structure and stuff like that. I don't call stuff super trend. But yeah. Yeah, I'll be teaching you a setup on this one here, but hang on tight. Let me get drill this through to you guys, because I know, and I've trained a lot of traders, right? I've taken a lot of traders under my wing. I've trained a lot of professional traders, and here's the thing with trading: traders will find any excuse to make their reason to open a position be legit, right? They like to convince themselves. So, because they like to do that, all right, there's a little bit of a disconnection here. All right, if you're that kind of trader, right, you jump in and up the time frame just to make an excuse to say, get a reason to open the position. I'll be frank, you're likely gonna fail. A lot of the traders are actually gonna fail. All right, because it's not about that. When we talk about multiple time frame analysis, you better pick a few or one and then stick to it and make sure it suits your trading plan, or else you're going to fail. You know why? Because if you keep jumping up and down that time frame, finding legit reasons to open a position or make it seems a little bit more legit, this is what we call inconsistency in the market. All right, is there an issue with the stream here? All green on my side. Okay, so yeah, let's talk about consistency. So yeah, Shed Ali, I don't know what that super trend is, and on the other candle, moving average 120 settings, I don't know what that 120 settings is. I think a lot of people, they when it comes to moving averages, in terms of looking at trends, I think the general one is either 100, 250 EMAs. I don't really use moving average as a trend indicator, but I've never heard of 120 being used. But hey, again, everyone can use whatever they want as long as they're comfortable with it. So intraday trading looks at a small time frame. Yes, we will talk about the criteria for those. That's true. Often lying to myself, right? Look, I'm not gonna lie, because when we talk about time frames, this is the reason why I'm not going any more on the slides. Because when we talk about time frames, a lot of people are just looking for excuses. They could be looking at the trend on the daily time frame, but they get impatient. And that the whole trading plan, which we're gonna talk about when we talk about risk management and money management later on, and that has a lot of impact on whatever type of trader you are. So this is really prepping you for that stage. But whatever plan you set out to trade, right, you get impatient. And I'll be honest with you, this week and probably next week, it's going to be a lot of headaches. Not because the market is hard to look at. It's just because a lot of people are actually impatient to actually stay away from the market, right? So stick to pair or strategy. That's different. We're talking about time frames right now. So stick to one time frame for now if you are just starting out. Anyway, let's get back to the slide. So we will talk about intraday trading, right? When we talk about intraday trading, what is intraday trading? It's actually really simple. It's intra within the day trading. All right. So we are going to observe the movement within that one day. But the problem here is that it requires an appropriate number of candles that can actually be applied to that trading strategy. Therefore, if you're looking at an intraday trend, you would be required to go on a small time frame to find that to find your trades, because if you're looking at the hourly time frame, you're technically no longer an intraday trader, because if you base your trades on the hourly time frame, there's only going to be 24 bars in that one day, all right? And you might not get in and out within the same day. So you're not really trading within the day if you are basing your trades on the hourly time frame. If you're basing your trades on the hourly time frame, you are likely a swing trader. So don't say that you're not a swing trader. Anyone here that base your trading on the hourly time frame, shout out on the chat. I want to see how many people of you are actually trading using the hourly time frame, because I know a lot of traders actually uses the hourly time frame and base their trade on the hourly time frame. If you are doing that, then let us know on the chat. I want to see how many people actually do trade on the hourly time frame. The requirement is that you look at the trend on the hourly time frame, you take your entry and your exit if you get in and out of a trade based on the hourly time frame. See, a lot of people are going to be saying me, right? Mudasar say I trade swing. That's a good observation. It's daily for analysis, 4 hour and the hourly time frame for entries. That's a swing trade. That's awesome. But Rohit, we are actually going to talk about the 4 hourly time frame and the daily time frame. There's actually a mismatch. We'll talk more about that. Okay, so a lot of you guys are actually saying, yes, it's me, right? But if you do that, then you cannot technically say you're an intraday trader, because an intraday trader will actually execute their trades on ticks, the 1 minute time frame, the 5 minute time frame, the 15 minute time frame, or some of them on the 30 minute time frame, right? So here's how it goes. If you are an intraday trader, and this is the classification for that, you want to get in within the day, and you also want to get out before the day ends. If that's you, then you want to be looking at the small time frames. When we talk about small time frames, it will be tick, right? I don't think you guys should be doing ticks. It's pretty dangerous unless you know what you're doing. Okay, 1 minute, it's really for scalpers. All right, they have different strategies. right? If you're trading on the 1 minute and the 5 minute time frame, the risk to reward ratio that you have doesn't click. You're likely going to have double the risk, and so yeah, instead of 1 to 2 risk to reward ratio, you'll actually be risking 2 to 1. Okay, you typically have double the risk. So if you're aiming for 10 pips, you typically are willing to risk 20 pips. That's if you trade on the 1 minute and the 5 minute time frame, just for example, right? 15 minutes time frame is actually the middle ground. This is ideal. In the stock market, or maybe not now. I'm not sure about traders nowadays, but I've been accustomed to 10 minutes if I'm going to trade within the day. As an intraday trader, I actually use this 10 minutes, right? Currency traders, because they're not accustomed to 10 minutes, they will trade using the 15 minutes time frame. I do day trade, but I day trade the equity market. I typically don't day trade the currency market. I swing the currency market, right? 30 minutes. I don't recommend 30 minutes because look, there are a few ups and downs on the 30 minute time frame. So it's a little bit too high of a time frame for you to execute your trade. It's too similar to the hourly time frame, but it doesn't really give a strong confirmation as the hourly time frame. So I'll actually scrap 30 minutes unless you're used to it. If you're new, I wouldn't be using 30 minutes. Okay, the hourly time frame, that's really the maximum. Some intraday traders do execute their trades on the hourly time frame. They could get in and out using the hourly time frame. That's within reason, because you got 24 hours to decide what you want to do. But a lot of intraday traders will look at the hourly time frame more as a trend guidance. They won't be looking for their entries on the hourly time frame, right? A lot of them, if they look at the trend on the hourly time frame, they will jump in on the 5 minutes. They will jump in on the 50 minutes. So let me give you a quick overview. So we're pretty clear on the overall trend on the pound USD. For example, right now, on the hourly time frame, right, prices within the Ichimoku cloud. Technically, it is not within any trends or whatever. If I were to look at it through Ichimoku, it means this is right now going to sideways market condition. It could transition to the downside. It could not, right? But right now, the overview on the hourly time frame is that we have a market that creates a higher low and a higher high, and continues to do so. All right, but we are starting to see the market transition by creating a new lower low. All right, so what we are looking at on the hourly time frame today, this could potentially transition into a downtrend if it does closes below 1.15. Now that's the observation that we have on the hourly time frame. As an intraday trader, does it mean anything to you? Right now, we do have a few key levels, right? We would be careful if price closes below this on the hourly time frame. And currently, if you're trading on the US breakout, we would have this range as a potential breakout scenario. So we can switch onto the 50 minutes time frame and look at the range here. On the 50 minutes time frame, this is already transitioning below the Ichimoku cloud. Because we don't have a breakout, we don't know what that trend is going to be on the hourly time frame. We could say, look, here's how we view the market. The hourly time frame is within the Ichimoku cloud. There's a lot of uncertainty going on. But if I were to look at the 50 minutes time frame, and we have a little bit of a range today, that's about 70 pips. It's actually not too bad, right? On 50 minutes time frame, if we have a 50 minutes close below that 1.15, then we could potentially see a breakout to the downside. We could trade this range, right? And if you trade a range breakout, it's always going to be about 1-to-1 risk to reward ratio. So we could apply that, right? We could say, look, I'll wait on the 50 minutes time frame. Once it breaks below that level, I'm actually going to I'm planning to sell this all the way down there if it does a breakout. Now, if I were to zoom out on the hourly time frame, that breakout would take the pair below the Ichimoku cloud, right? That's the assumption. But because it's a range breakout, what if price breaks to the upside? It will be back above the Ishimoku cloud. So I would, right now I could say on the 50-minute time frame, I'm on standby. If it breaks above 1.1575, it could potentially lead up higher. If it breaks below 1.15, it could break to the downside. Does it make sense? Yeah, because if we take a look at this one here, it's 1.1575, which is also a psychological level, and 1.1150, also a psychological level. So my range is okay, right? It makes sense. My range is perfectly okay. If it does break to the upside, then I would probably go long. Once it breaks to the upside, and I'll have the other side as my stop loss, then I'll have a 1-to-1 risk to reward ratio. This could be my trading plan, right? And I'm using multiple time frames to decide what I'm looking at. I'm looking at the trend on the early time frame, and I'm trying to execute a trade today on Friday. If there's a range breakout, and that range is within a 75 pips, it's actually between, a key support level, a key psychological support level, which is at 1.15, and a potential resistance at 1.1575. So this observation makes sense, right? But it is still just an observation, and this is just an example. Do not take this trade, right? This is just an example to give you a view on how you actually look at multiple time frames. One is to determine what kind of market it is in, and then the other one to actually plan your trades. But if I have my view on the 15-minute time frame and I plan everything out, right? I'm waiting for that breakout on the 15-minute time frame. Don't jump into the 5-minute time frame and say like, hey, yeah, you know what? I'll just wait. I don't want to wait 15 minutes. I want to get in earlier. I'll look at the 5-minute time frame to jump in on that trade. Don't do that. Okay, so when we talk about multiple time frames, it's really just 2 time frames, right? Simple as that. Depending on what type of traders you are, do not confuse yourself with more than 2 time frames. I'm a swing trader. I'm a position trader, and sometimes it's really, really ridiculous if I were to jump on and look at someone telling people how to look at the market, and they look at the weekly and the monthly chart, because it doesn't click. It no longer clicks, and it doesn't apply to whatever you're looking at in the market. If you're looking at on the early time frame, if you're looking at stuff on the early time frame, what has the monthly and the weekly chart going to do to you? It's got nothing to do with you, because the time differences is so big, so far apart. It's useless. It's meaningless. Okay. All right. So that's intraday. So this is going to make things a lot easier. Sorry, let me just see that question's there. Easier said than done. H1 is for intra-week, yes. All right, so there's some else. I like this answer. Not even decided on my time frame. I basically am trying to research and gather as much knowledge as possible for going into practical trading, and this is good. And someone was asking if I just join and I'm a completely new beginner, is this going to be useful? Yes, it's going to be useful to you. Don't jump time frame. Simple as that. Pick one time frame, stick to it, get until you get really used to it. Right? Look, you're not supposed to feel forced by anything. So let's say you're within a group of communities and they are all scalpers in the market. I don't like the idea of scalping. I'll be honest with you, I do not like the idea of scalping. But that's me. All right, a lot of you guys like scalping, and you guys don't. It feels okay with scalping. All right. So if you are looking at a certain time frame, and you feel that you're not suitable with that time frame, for example, if you take a look at the other time frame and you're a very impatient person, you want to get in and out within a day, then go into a small time frame. Or maybe you're looking at a 15-minute time frame and you think, you know what, it's so confusing, market goes in and out, it's really choppy, then go on to a higher time frame. Simple as that. can we have the Ichimoku settings? We did talk about the Ichimoku already. We had that webinar 2 weeks ago and last week. In terms of the Ichimoku settings, you're not supposed to change any of the settings. It's going to be 9 for the Tenkan. Kijun is 26, span B is 52, Chico is 26. Alright, let me go through with the slides first, and then we can talk about the examples. So this is for intraday. This is for swing trading. When we talk about swing trading, it's it's not really intra-week, right? But in the context of currency market where things changes really quickly, a lot of people say the observation that we have on swing trading is really observing the movement for 1 week. It's going to be within the week. It's going to be intra-week. I don't quite agree to this, but that's basically it. For me, swing trading, it's really flexible. Swing trading is basically this. If you hold a position more than a day, you would be considered doing a swing trade, right? Typically, swing traders clear off their position within the week, but some swing traders might hold on to that position for a longer period of time, depending on what kind of trading strategy they have. So let me explain a little bit. I categorize myself as a swing trader because I don't like trading within the day. Most of the time within the currency market, I'll day trade the stock market. I don't typically day trade the currency market. So in terms of currency market, I would call myself a swing trader. But am I going to clear off my position within the week? No, because I am a trend following trader. Therefore, I would go for as long as the trend takes me. And that would transition me between swing to sometimes even a position trade. All right. For example, last year we did great on oil. It was initially a swing trade that transitioned into a multi-month trade. So, does that fall into swing trading? I would say yeah, because the initial logic behind opening that position was based on a swing trade. So let's make it simple. Swing traders are basically this: anyone that holds a position for more than 1 day, sometimes up to a week or longer than a week, would be called a swing trader. All right. Can you jump in on the 15-minute time frame? Yes, you can. All right. You don't jump in on the 5-minute time frame. You don't use a 1-minute time frame. You're using the 15-minute time frame to actually jump in and trade, and you could actually hold on to that position maybe for a day or two, and that's still completely fine. Okay. You could use the hourly time frame as your trend observation. You could use that as an entry or exit. That's completely fine. Now the 4-hourly time frame, I label this as a single time frame trend observation. What I'm trying to say is this: the 4-hourly time frame is a little bit unique. Is it accurate? Yes, it's pretty accurate. But it's only accurate if you don't confuse yourself with the hourly time frame and the daily time frame. What I'm trying to say is this: if you use the daily time frame, do not use the 4-hourly time frame to look at the trend, because they could potentially give you a different view of whatever the market is doing. So here's the 4-hourly time frame. All right, this is on the pound USD. This is the 4-hourly time frame. What does that tell you? If I were to look at the 4-hourly time frame and then I were to look at the daily time frame, it means nothing. All I'm going to get is I'm just going to get confused. You know why? Because on the daily time frame, we're still in a downtrend. On the 4-hourly time frame, we're in an uptrend. On the 4-hourly time frame, we're in an uptrend and really far away from the Ichimoku cloud. On the hourly time frame, we are within the Ichimoku cloud. Right? See where I'm going with this? So if you were looking at 3 time frames, if you were looking at the daily time frame, you're looking at the 4-hourly time frame, and you're looking at the hourly time frame, because you think that by looking at these 3 time frames, I could get a better understanding of the trend, you're not going to get that. The 4-hourly time frame is a little bit unique, and this is from my personal experience using the 4-hourly time frame, the daily time frame, and the hourly time frame. There are certain instruments that I use the 4-hourly time frame on. And if I were to plan my trades on the 4-hourly time frame, I do not look at trends on the daily, and I don't look at trades to jump back to get in on the hourly. Okay, if I were to use the 4-hourly time frame, I would use that 4-hourly time frame independently to plan my trades, to look at my trend, and it's just one single time frame. Okay, the reason being, on the daily time frame, if we look at the trends and you want to get in on the 4-hourly time frame, the time difference, it's just not a lot, right? You're not going to get a lot of bars to actually plan your trades on the 4-hourly time frames if you're looking at the hourly, the daily trend. If you look at the trend on the 4-hourly time frame, you only get 4 bars. On the hourly time frame, you don't have enough space to do anything. Okay, you could use the 4-hourly time frame and the 50-minute time frame, but take my words for it, it doesn't really apply, right? If you're going to be doing that, might as well do that, 50 minutes on the hourly time frame or 50 minutes on the daily time frame. That would be a much better option. The 4-hourly time frame and the 50-minute time frame, I tried it out, and if you try using them both, I don't find a lot of success on it. So I'm going to save you a lot of trouble. If you are using the 4-hourly time frame, anyone here using the 4-hourly time frame, shout out on chat so I know what kind of trader you are. If you're using the 4-hourly time frame, you are guaranteed to be a swing trader. So if you all, there was a question just now, I was looking at swing trading and I was looking at the daily 4-hourly time frame and the hourly time frame. Don't do that. Okay, so you can use daily and the hourly time frame. That's completely okay. For hourly time frame, you need to be independent. It's really unique. Okay, but not if you're using the 4-hourly time frame. Stick to the 4-hourly time frame. Don't jump around. Right. So Rohit was there. So I'll ask Rohit. How's this? How do you find looking at the trend on the daily and then finding your entry on the 4-hourly time frame? Do you find that sometimes it's a little bit too late or sometimes it's a little bit confusing? How do you guys find that? Honest opinion, because everyone's gonna have a different opinion. It's just from my takeaway, I find that using the daily and 4-hourly time frame is giving me a lot of headaches. Okay, so we're not here to talk about the market today. We're really here to learn about multiple time frame analysis. So if you want to know what's going on in the market, if we have time, I'll talk about it. Otherwise, you wait for that Monday's outlook. Okay, so daily use or 4-hourly time frame should be chosen according to preference. So pick one. All right. Trend overview between the 4-hourly time frame and the daily are not really compatible with each other, so it's better to choose only one if using multiple time frames for analysis. And it's really simple. Just by looking at this, someone was saying pound USD is very volatile. I don't think it's. If you think this is volatile, wait until next week. Wait until you come to the 2nd and the 3rd of November. You're gonna blow your mind. All right. So daily, 4-hourly, pick either one of those, right? So if you're using the 4-hourly as a trend to trade on the hourly time frame, stick to that. If you're using daily and the hourly time frame, stick to that. Don't use daily and the 4-hourly time frame. You are going to get a lot of headaches. It's just that it just doesn't rhyme, the timing. Sometimes trends might be opposing, but usually I stay away if hourly and 4-hourly and daily isn't in the same direction. Okay, so Tian, I know you, right? And we're pretty much in line with what we're looking at. So if you guys don't know what's really going on, just from a technical point of view, what you want to look at the daily time frame, let me give you an illustration. So on the daily time frame, we are borderlining, potentially transitioning into a potential new trend on the daily time frame. Let me get rid of that lines on the 50-minute time frame because it's just gonna get a lot of confusion. Right. So this is daily. All right. It's potentially transitioning. The 4-hourly says we are already in an uptrend. And the other time frame says we are within the Ishimoku cloud. We could potentially transition even lower. So let me put 1.15 as a key level, then we can take a look at this in context around 1.15. So this is what we have on the hourly time frame. This is what we have on the 4-hourly time frame. So what are we trying to look at here? If we take a look at the 4-hourly time frame and say, you know, there's a 4-hourly close below 1.15, then we could potentially transition even lower. Now Rohit was saying, you know, the hourly time frame or the 4-hourly time frame, whichever comes first, the hourly time frame will always come first, right? Because if you look at the hourly time frame, it will close first compared to the 4-hourly time frame. So the answer you've given me, I'll just answer it to you right now. Don't look at those just because one gives you the other, because the hourly time frame will always be faster to give you that answer. And the reason why I don't like using the 4-hourly time frame and the daily time frame is this. I much prefer, and I have a lot more control in knowing that every hour closes about the same time every hour. I know there are certain regions in the world that has a little bit of a weird GMT. Sometimes it's like 0.30 GMT. That would change perspective a little bit. Nowadays, 4-hourly time frame pretty much starts about the same. Back in 20 years ago, 15 years ago, every broker starts the day differently. Everyone has their own different time. Sometimes the 4-hourly time frame could show you different candles depending on the brokerage you use. That was an issue that I have with 4-hourly time frame. The hourly time frame is going to be consistent depending, no matter what time their day starts, right? The hourly time frame is always going to be consistent. The 4-hourly time frame could look different from brokers to brokers or different data providers. Okay, so going back onto the 4-hourly time frame and the daily time frame, this is where it gets a little bit weird. If I were to say on around 1.15, we would take a look at that context at 1.15. I can make an assumption that if price breaks below 1.15, it could potentially go to 1.13, 1.12, and bounce off the Ichimoku cloud. And if I were to go to the 4-hourly time frame, this would be about right, because on the 4-hourly time frame we would be looking at a potential bounce of the Ichimoku cloud as well. The difference is, and this is the difference in context, one, on the daily time frame we just transition above the Ichimoku cloud. On the 4-hourly time frame we have gone through the Ichimoku cloud. We're just coming back for a potential support test. This is going to give you a little bit of a headache on the hourly time frame, because the hourly time frame would transition it below the Ichimoku cloud, therefore the trend would be different. Okay, this is the reason why I say if you look at 3 different time frames, the daily, 4-hourly, and the hourly, it's going to create a lot of confusion. And you as a trader, you don't want that confusion. You want to have as little of a confusion as you can, right? So either you stick to the 4-hourly time frame and stick to it, have a go. You can come back in a week's time or 2 weeks time and tell me the result, because I'm actually going to ask that once we come into the trading journal part. I'm actually going to ask you, if you have come up to a decision, what time frame you're going to be using. Okay, but have a go at it. Try to use different time frames. I'll actually give you we are running out of time for tonight, but I'll give you a few combinations of what time frame to use for if you're going to be looking for trends and stuff like that. But trust me on this one, do not use daily, 4-hourly, and hourly together. Either the daily and the hourly time frame, or the 4-hourly time frame and the hourly time frame, or the 4-hourly time frame independently. Do not use daily and the 4-hourly time frame together. They are going to give you conflicting trends most of the time. It's actually going to give you a lot of confusion. All right. This position trading, this is probably sometimes I do this, and I will do this for commodities. I'll actually take the daily as an entry on oil. I trade oil as commodities. I don't trade gold. I don't trade precious metals. I don't trade silver, but I do trade oil, both Brent and crude, WTI. So yeah, I would use the weekly as the general trend overview. I would use the daily as my entry. I would use the 4-hourly time frame and the hourly time frame as a re-entry into the market, right? The 4-hourly time frame could be the main entry, but the hourly time frame is always going to be a re-entry for me to that trend, right? I'm a trend following trader. I will ride the trend wherever it goes. All right, I will look at the weekly for my trend direction. You know, how far can it go? How long do I have? And I'll jump in on the daily. I'll look at the trend. Does it make sense? If it just transition, I'll trade that trend, and I will ride it for as long as it goes. Okay, you guys know that. I've been riding down the pound train really crazy. Just got out of my position because there's a little bit of a transition this week. But yeah, this is more like me. Do I call myself a swing trader or do I call myself a position trader? I still call myself as a swing trader, but really depending on the context of use here, right? So if you are position trading, you are going to be observing a movement that's more than 1 week, okay? Therefore, you're looking at multi-month trend, multi-year trend, and that would be position trading. And I do this for my portfolios. If I have a longer term portfolios, I will use this methodologies to actually jump in and hold on to my position for a long period of time. Is it advisable for new traders? Not really. Okay, here's where it gets a little bit weird. Someone just say you are new here, so I'll just give you a little bit of a, a little bit of an insight into what it is. Scalping or intraday trading, it's super hard for beginners because one, you typically don't have the mentality for it. You don't have the know-how, you don't have the risk management, you don't have the money management. And this is why a lot of people blow up their accounts, because they're thinking if I were to jump in and out within the day, I could make a lot of trades, a lot of profitable trades. It just doesn't work that way. Okay? If you're new, try to get your bearings right by being a swing trader. Okay, it will have a lot less noise. Okay, don't get confused a lot in terms of, mentality. No one's there to rush you. Position trading is going to be tough if you don't have an investor mindset. If you do not trade stock markets, if you never ever hold a portfolio for a long period of time, this is going to be tough. The reason why this is going to be tough is because you are going to be asking yourself every single day, is my trade safe? And if you're asking that questions when you have an open position, you're not really suited for position trading. So I cannot answer this for you. You need to answer this for yourself. If ever in your trading career you feel that holding a position overnight or holding a position for a long period of time causes a lot of stress for you, then don't. Simple as that. We'll talk about more about this when it comes to trading psychology. But trading is this, right? If you want to be successful in trading, one, you need to be consistent. Number two, you need to be comfortable. If you're not consistent, it means that you're not comfortable. Okay, so it's simple as that. No one is here to tell you what time frame to trade in. That has to come from you. Okay, because I have my own preference. I don't know what your preference is. So think about it very, very carefully. What type of traders you are, that's going to decide whatever time frame you're looking at. Okay? So, pros and cons of multiple time frame analysis. Pros. A higher time frame can give you a more accurate exit. This is a proven fact, because it will give you a much wider range. It will actually give you a much more accurate exit. A higher time frame describes the underlying trend more accurately. This is also true because the smaller time frame, there's a lot more noise going on. Okay, the longer the time frame, the clearer the picture is going to be. Therefore, the clearer the underlying trend is going to be. Right? You don't see FOMC looking at the 5-minute time frame and the 15-minute time frame and then decides on their monetary policy. All right, they will look at weekly, monthly data. For example, those fundamental data every day, every week. The monthly, it's really more of a short-term data. Inflation numbers, we look at the yearly inflation numbers. Okay, that's 1 year. All right, we look at the quarterly GDP numbers like the US last night. Okay, we don't really pay closer attention to the monthly numbers unless it's really important that it could potentially change the quarterly or the yearly numbers. Okay, that's where the logic is. A lower time frame can give you an indication of market changes that matches the overall picture of a higher time frame, and I'm going to use the daily and the hourly time frame as an example. We are borderlining here right now. Okay, and the hourly time frame suggests if it does break to the downside, if we do break below 1.15, then yeah, we could be in for a much deeper correction that's in line with the daily time frame, where we actually are observing a potential for this one to go back down to the Ishimoku cloud. Okay, so that could be that. Okay, and this is going to answer that questions whether the small time frame is going to affect the bigger time frame. Yes, it does. Okay, a lower time frame can also provide you re-entry for a trend that's running on a higher time frame, right? For example, if I'm looking at the trend on the daily time frame, and I read that trend, I opened my position, let's say on the 24th of February 2022. I don't get a lot of re-entries because I don't see price transitioning above the Ishimoku cloud and then coming back down. But if I were to jump on the hourly time frame and I take every short position, every time it crosses below the Ishimoku cloud, I open a short position. How many entries do I have ever since the 24th of Feb? A lot, right? It was significantly a lot. And I could be riding on that train all the way and, and be happy about it. Okay? So those are the pros. Okay? So basically, multiple time frame analysis is actually used to maximize the movement of a trend. Get it? If you're not a trend trader, multiple time frame analysis will actually do little to your trading. Okay? There are a lot more cons to this if you're not really a trend following trader. So make sure you understand what you're doing here, because on a multiple time frame, the observation of that trend can be a confusion, because one hourly time frame could tell you it's an uptrend, the 50 minutes could tell you it's a downtrend, and then you might not like to go against the trend on the hourly time frame. Then you might miss out on the intraday trade that was given on the 50 minutes time frame. So that's going to be a lot of confusion. So make sure you know what kind of trader you are. If you're not really a trend following traders, multiple time frame analysis will actually do little to improving your trading strategy. Okay, in fact, it could actually be more of an obstacle. Okay, incorrect time frame can be a problem. Okay, let's say you're not really comfortable holding a position for a long period of time. Maybe looking at the daily time frame is wrong for you. Maybe looking at the hourly time frame is wrong for you. Maybe you should be looking at the 50-minute time frame. But because your friend says, I'm looking at the hourly time frame. Someone says they're using the daily time frame. That could affect you guys, right? So right now, I could be affecting you guys in terms of your thinking, in terms of your mindset, because I say I'll use the daily and the hourly time frame. Then you might want to be, you might want to look at how I look at the market, and then all of a sudden you look at the daily and the hourly time frame, and you might not be suitable for that time frame. But I could influence you on that, right? It's all a matter of mentality. Information overload can have an impact on your trading psychology. We will talk about trading psychology later on. We'll talk about trauma recovery and stuff like that. But me talking to you right now and saying I use the daily, I use the hourly time frame, you might not realize this, but it's slowly seeping into your mind. It could change how you look at the market, right? That's going to be the same with any traders out there that says, hey, I look at the weekly time frame and then I jump in on the hourly time frame or the 5-minute time frame. And I've seen this. People actually look at the weekly time frame as a general trend, and then they try to jump in on the 5-minute time frame. The relevance of it, it's like, wow, seriously, how's the 5-minute time frame going to ripple effect onto the weekly time frame? We talk about butterfly effects and stuff like that, but this, for an intraday trade, what are you doing as an intraday trader looking at the weekly trend? It just doesn't click. So the purpose and the goal kind of have to be reasonable, all right? The other issue that I have in multiple time frame analysis is that if I were to use divergences, I would get opposite divergences, and that would cause a problem. because I would be able to look at the daily time frame is showing me a regular class A divergence, and then on the small time frame I could be looking at hidden divergences, and that's gonna confuse me a lot. So I don't like that. When you try to look for divergences, don't look for divergences on the hourly time frame and then compare it to the daily time frame. It has different context, it has different meanings, so I'm just going to save it here for you. If you use multiple time frame analysis and use divergences, you are going to get a lot of opposite divergences. You're going to get a lot of problem because that's going to cause a lot of confusion. Choose one. All right. The issue that I have is really a lot of people, you look at multiple time frame analysis and say, you know, I look at multiple time frame analysis to get everything in the same direction before I make my trade. But the opposite is true, that you're actually going to get to see a lot more different trends on those different time frames. That's actually going to cause doubt on your trading. So let's say you find a setup on the hourly time frame and you say, oh, this is so good, right? Right. I want to take my trade that, you know, if it breaks below 1.15, risk reward ratio makes sense. You know, I like this trade. Then I go into the daily time frame and say, look at this and say, like, well, this is within the Ichimoku cloud. What if it fails? You know, what if it doesn't? What if transition above the Ichimoku cloud? And what if it doesn't go back all the way down? What if it goes all the way up to 1.17? I'm gonna get stopped out. Okay, so see where I'm going with this? Look at multiple time frame because they give you a different view of the market, different observation, different context. You, most of the time, are not going to get that agreement that says, yeah, you know what? I've got proof and evidence that this is going to go that way. No. Okay, you are going to get confused. And this is the problem that I said at the beginning. People are actually going to use different time frames to make their trading plan sounds acceptable. And then they're just going to give that reason to themselves and say, you know, I took that trade because I look at the daily time frame. And yeah, it all meets all the criteria. And then the next trade you take, you know, I don't look at the daily time frame. I look at the hourly time frame and it meets my criteria using the same trading strategy. This is the issue that that's actually, you don't realize it now. But this is actually going to have a lot of impact on your trading. This is going to create a lot of inconsistencies in your trading plan and your trading strategy. Okay, so think about it in that context that you are looking for consistency. Okay, so this is going to be your best time frame combination for intraday trading, and I'm playing around with 2 time frames, and that's pretty much it. So you could look at the hourly time frame for your trend, 15 minutes for your entry. You could be using 50 minutes for your trend, 5 minutes for your entry, 15 minutes for your trend, 1 minute for your entry. And the last one, I probably would say, you know what, don't even go there. This is just plain ridiculous. This is really for, it's okay if you code quants on it, right? But for a human being to look at a 5 minutes trend and then trade on ticks, it's just a little bit too hard. There's going to be human error. There's actually going to be delay for it. So I would say scrap that last part. Okay, best time frame combination for intraday trading, the hourly and 15 minutes. I like this a lot. 15 minutes and the 5 minute time frame, 15 minutes on the hourly time, 1 minute time frame. That's still okay. Just not my type. Okay. All right. Best time frame combination for swing trading. You could look at the 4 hourly time frame and the 50 minutes. Okay, you could look at daily and the hourly time frame. You could look at daily and the 50 minutes. Okay, daily or the 4 hourly use must be chosen according to preference. Pick one. Okay, trend overview and the 4 hourly time frame and daily are not compatible for observation together. So think about it. Look, this is really a tip from me, but you want to believe it or you don't want to believe it, it's completely up to you. But I've done my test on the 4 hourly time frame and the daily time frame, and this is my finding. You're better off choosing one, either the hourly time, the daily time frame, or the 4 hourly time frame. But if you're using multiple time frame, then you can choose whether you want to use the 4 hourly time frame or the daily in comparison to 50 minutes. That's fine. Okay. Best time frame combination for position trading: weekly for trend, daily for your entry. This I would do that for multi months if I were to build a portfolio for that I'm gonna keep for years. This is what I do. I will look at the weekly trend and then looking for the entry on the daily or the 4 hourly time frame. Pick one. right? Or maybe if I'm thinking maybe I want to invest something for 10 years or 20 years, then I would actually look at the monthly trend and then using the weekly as my entry. That's really more of an investor mindset. Okay. Sorry, man. I'm actually going to have to apologize. Sorry about my cough. It's not really my cough. I've been having issues with my vocal cords for a good 1 year now. So it might look like I'm constantly coughing, but it's not. My vocal cord just gets strained a lot and I just have to kind of reset it. All right, let me go through the questions, but that's pretty much it for tonight. If you guys have any questions regarding time frames and stuff like that, do let me know. What should be the entry trigger on the early time frame? Depends. Look, Rohit, the entry trigger on the early time frame is going to be your trading strategy. What I'm trying to say is that you look for that trend on the daily, and then you use whatever trading strategy that you use and apply it on the early time frame. So you might be using a moving average crossover, you might be using a breakout strategies. So don't apply it on the daily. Look for the daily for trend direction, and then apply it on the hourly time frame that goes in the same direction as the daily. That makes sense. If I only use hourly Ichimoku with Cloud, Kijin, and Tenkan and Enter, is that enough to become profitable? Really depends on the asset class, because some asset class it might not work that way. But if you use this on the daily, I think you have a much better probability. It's just that, do you have the mindset to be able to take a huge risk in the market? If you don't and you're not comfortable, don't. Whatever trading strategy it is, as long as you're comfortable. If you're comfortable using it on the hourly time frame, that's, I would say, you know what, stick to it, give it a go, see how it goes, okay? If it doesn't work out for you, you know, try something else. Yeah. Look, I like this, Jocelyn, and I'm actually going to agree with you. Technical or fundamental, it's really just 20%. Like, psychology and your mental state is 80% of trading. And I'll be honest with you, it's not the strategy that matters. It's your money management, it's your risk management, it's your mentality. It's whether or not you're consistent, that, you know, you could consistently repeat the same process over and over again until you are, you know, you take trading more as a robotic thing rather than being an artistic thing or based on your emotion. That's basically how you transition to become more of a consistent trader, right? A successful trader to me is one that actually finds consistency in their trading. Anyone that's consistent in their trading is going to be successful in their trading. One out of topic question. I've seen Ichimoku session multiple times for practicing. Request you to consider part 3, as many people, including me, are curious to learn more about it. Yes, we will try to schedule part 3, but it might be more as a bonus. I know some of you guys have attended it in Bahasa Indonesia session. If I were to do part 3 in English, it might be after we finish risk management and money management. Sometimes the sudden movement or fake out is made even though we analyze everything according to our plan and check everything in different time frames. How to avoid it? What triggers that fake out? That's what I want to know, right? For example, this month in October, there were 2 Ministry of Finance, Japanese Ministry of Finance intervention in the Japanese yen. Do they cause shock in the market? Yes. The first one does. Is the second one anticipated? To a certain degree, yes. We kind of tread carefully when we break above 150, for example, right? Because we anticipate it. With the ECB last night, were you guys hoping that the euro is going to get stronger because the ECB hiked by 75 basis points? You know, the concern wasn't the 75 basis points. With the ECB and with any interest rate hikes, it was never the interest rate hikes that's going to be the concern. If they come in as expected, and I always discuss this when we talk about, interest rates, which next week is going to be one, all right? It's always what the central bank says that could give you a clue to their future rate hikes that's going to have an impact on the market. If you guys were not listening in to the ECB press conference last night, one word that Christine Lagarde said was they have done enough work to actually tighten monetary policy. Now, that word itself, that sentence itself, was basically an indication that, we hike 75 and we have done enough. We might not actually hike at 75 basis points. And that causes the euro to fall down. So this is an example. So we are actually going to talk about this when we talk about trading psychology. I believe this is actually in trading psychology part 2. We will talk about this something that you have analyzed and something that wasn't part of that analysis that causes something bad to go on your trade. How do you actually handle that? We will actually talk about this in trading psychology part 2. So that's coming really, really soon. So yeah, I already answered that. How do you enter using the hourly time frame, candlestick chart, pattern breakouts? It really depends, whatever you want. So if you look at the chart patterns on the hourly time frame, then you enter based on the hourly time frame once you have a confirmed close above or below it. Simple as that. You want to use candlesticks on that? Yeah, you have that confirmation on the hourly time frame. As long as you get that on the hourly time frame, and you trade within the hourly time frame, that's completely fine. Remember, if you look at multiple time frame analysis, one is always going to be looking at the much bigger picture. What is the underlying trend? The other one is for your entry and exit. Simple as that. How do you recover trading in losses? Halim Saputra, I'm assuming you're Indonesian. There's actually already a webinar on that. I'm actually looking at it right now. What is it? If you were to look on, I'm actually reviewing it right now. If you go through risk management, that's already part of it. I've done this in Indonesian, by the way. You can type in my name and then risk management on the OctaFX YouTube channel. You might find it. Otherwise, there's one title, Melatih Pola Pikir Trading. You can look into it for that. That's going to give you a mindset in terms of trauma recovery. I like that feedback. Attending this session with you guys helped me put things into perspective. Developing a protocol routine, which is really important. We will talk more about that when it comes to risk management and trading psychology. I like routines. I like to be in control. I like to be disciplined. I like consistency. All right. So I'll be honest with you. It's not a trading strategy that's going to make you successful. I don't use complicated trading strategies. You guys know that. A lot of you guys know what I'm using. What I base my decisions on. Really, I try to make it as black and white as possible. I don't like to be in the gray area. So you guys IT people, you guys know the 1-0, right? The IO switch. That's pretty much when it comes to trading. You develop a set of plan and you're going to execute it no matter what you feel. That's that. Simple as that. So yeah, if it molds you, then it's great. So if you guys are a beginner and you guys are watching this, I would say don't just buy into what people are saying. There's no one good strategy out there, but I would say find whatever you're comfortable with, and this would apply to your time frame. Whatever time frame you're comfortable with, that's going to dictate what kind of trader you are. And that's going to have an impact on your consistency. That's going to have an impact on your trading psychology. That's going to have an impact on your risk management and your money management. Okay, but it all starts with whether or not you're comfortable. Simple as that. Okay. Right, any questions? Otherwise, we are going to wrap it up for this week. Thanks for joining in. Good luck for your trades. and we are gonna have a super crazy week next week. If you guys don't know what's going on next week, we've got the Bank of England going to be hiking interest rate the same day the fiscal policy is going to be announced in the UK, the new one. The day before that, we've got the FOMC rate decision, and then on Friday, so starting on Wednesday, Thursday, Friday, it's going to be a jam-packed, explosive week next week. So a lot of people are actually staying out of that trade. A lot of people are actually staying out of the market for next week, waiting for the November 2nd and November 3 to kind of explode. The market could really crash if everything goes wrong next week. So just a warning out there, volatility is going to get really extreme, and this could be one of those crazy days within the year. All right. Have a great one, everyone. Good luck with the trades, and I'll see you next week, yeah? Have a great weekend ahead.